Wonderful. Well, welcome everyone. We're going to give folks just another few seconds here to get situated, and then we will start with today's webinar. Just a couple of housekeeping items before we officially kick off here. You all will have access to submit questions and make comments in the chat. There is a Q&A option on your screen, as well as a chat option. Would love for this to be a participatory meeting, and so as such, if when you do have questions or comments, please do use those resources to share with us your thoughts, ideas, questions, and I will be fielding those as they come through. Sid and the GreenLyne team have requested that this be a casual, open format conversation. So with that, don't be shy with asking your questions and jumping in when you have them. So with that, we are a couple minutes past the hour here. We'll go ahead and get started. And the last thing I'll just mention is we are indeed recording today's session. We'll provide a follow-up after our meeting here today. And so all those things that you'll learn about and our conversation during today's session will be recorded and shared with you after the fact. So with that, Ben Herring, I am the Director of Partnerships here with CUCollaborate. I've been in credit unions now for about 13 years. I used to work for a credit union here in Minnesota, which is where I live and work from. And then I worked for the Minnesota Credit Union Network, which is the league here in Minnesota, and joined this CUCollaborate team last year to do, as my role entails, help the company build relationships with organizations that can help our clients do the wonderful things that they do. And so that is what brings us here today. CUCollaborate is a 10-year-old organization. We are now, excitingly, a CUSO. So we have a number of credit unions who have invested in our organization, and we're extremely proud of being a credit union service organization. It's going to allow us to continue to do some of the wonderful things that we do with our credit union clients. Today's webinar is really focused on one of our partnerships that we recently established with GreenLyne, and I'll certainly save much of the information around who GreenLyne is and who we have on the call here for them to elaborate on. But I will just say a few things about our partnerships in general. So one, a lot of what CUCollaborate does is strategic in nature. We are a credit union growth company who specializes in building and evolving software, as well as providing consultative services to credit unions. On the data and analytics side, we've really been focused on helping credit unions envision what their growth looks like on into the future. And so we do that through analytics dashboards. We have a proprietary mapping software that helps credit unions understand what expansion and growth looks like in a visual way, as well as we actually started off in our journey building member acquisition, like a tool that helps credit unions get those prospective members to become actual members at the credit union. And then on the consultative side, have been really spending a lot of our time, energy, efforts on helping credit unions expand through field of membership expansions and charter conversions. We have, as a result, worked with many credit unions on envisioning how to take advantage of beneficial regulatory programs, such as the low income designation, obtaining CDFI certification, and we do a lot of other kind of like niche regulatory program work. And then, yeah, everything that we do is under the guise of helping credit unions grow and be prosperous on into the future and do the wonderful things that you guys do. So when it comes to our partnerships, we look for organizations that we can align with to help our credit unions do some of those things. And so a lot of what you're going to hear about today from GreenLyne is reaching consumers who are not being reached by the financial institution environment. And so we looked at relationships with several different partners and have relationships with a handful. This particular one is really all around inclusive finance. And I'll again let them talk more and more about that. But what they do in partnership with CUCollaborate is leverage some of our software and our expertise to align how they reach consumers with credit unions and financial institutions that are seeking to, let's say, boost their CDFI lending or reach consumers in underserved areas of their market. Maybe they're looking at needing to source members who would help them with their low income designation. All of these things are things that GreenLyne can help your credit union with. So with that, I'm going to hand it over to our friends over at GreenLyne and let them take it away. So from here, Sid, go for it.
Fantastic. Thank you so much, Ben. That was a wonderful intro. And thank you, everyone on the call. It's indeed such a privilege to be here with all of you. We have a lot that we're going to try to get to here, so I'll just go ahead and jump right in. By way of introduction, I'm Sid Mansour, the CEO of GreenLyne. GreenLyne has been 10 years in the making. We have been in the space of inclusive lending and facilitating inclusive lending for bank partners and credit union partners. And we've also have worked with regulatory agencies to really solve what has become a critical challenge, and that is to close the wealth gaps and the racial home ownership gaps, and just simply affordable access to credit. Out of all the credit facilities that are out there, secured loans, home equity loans, home equity lines of credit, piggyback seconds that are used at the time of purchase, they have profoundly beneficial loan terms, 20-year terms. They have amongst the lowest of interest rates. And yet these loans have, for a variety of reasons, been somewhat inaccessible. And so we'll talk about the technology and the platform that we've developed and the services that we provide that really open up the window of inclusivity and access and very safe and responsible lending around this credit facility, i.e. home equity loans, HELOCs, and piggyback seconds. Right before we dive in to the technology and the innovations that we think can address this need and address this challenge, I'd also like to introduce my colleague, Abik Sambial. He's our Chief Product Officer and has been instrumental, along with our other teammates, in really kind of rising to the occasion and helping us address this challenge. So, and as Ben mentioned, we love to make these presentations conversational during the course of the discussion. Please, please, please don't hesitate to raise your hand, to interject. It's not an interruption at all. And it just ensures that we're not moving too fast and creating confusion along the way, as long as we keep it conversational. Okay. So, I think the punchline around the solution is this. Fundamentally, home equity loans have been the venue of larger size loans. And it's primarily because these loans have incurred meaningful cost to originate, meaningful cost to market, meaningful cost to service. It's time consuming for borrowers. It's time consuming for loan officers. It's time consuming to apply. It's effort intensive. There's a lot of documentation gathering that needs to happen, et cetera, et cetera. And the other thing that we have heard very significantly over the years as we immersed ourselves into underserved communities and spoke to specifically low to moderate income LMI communities is this concern that if I lose my job, or if I lose my health and I'm on medical disability, or I lose my income, I don't also want to lose my house. For a small sized home equity loan, something that is, let's say, $30,000, $20,000 in size, I'd rather just spread that debt out across credit cards. And so we knew that one challenge around the marketing, the acceptance, and the accessibility of this loan is a psychological or an emotional accessibility. And so it was really important to us to address that problem head on, that problem being that real psychological burden that folks would feel, particularly within the underserved cohorts, for taking out a loan that is collateralized by their property instead of just putting their credit needs on a credit card or on a high interest rate personal loan. And the way we addressed that is we said that, look, every credit union, every financial institution is going to have its own underwriting guidelines, primarily defined by FICO score, DTI, and debt to income ratios and loan to value ratios, LTV. And each one of those institutions is also going to have its own price sheets, rate sheets that are also pegged to those three variables. Let us actually take those three variables and let's go one step further and say, you know, even if someone fits within a credit box, there's still a lot of there's a lot of wiggle room in terms of what is the right loan size that they should be offered. Let's pinpoint a loan size that is truly affordable, safe, responsible for that particular borrower. And let's pinpoint it using a fourth variable that we now have real, easy, frictionless access to, which is looking at their bank statements and understanding how much residual income do they have every month to be able to service an additional debt. And then using some portion of that residual income, we can peg the monthly payment that they can safely afford, and then back out from that monthly payment what the loan size should be given your interest rate sheets. Now, given the models that we've developed and our deep comfort in our own models to do that loan size optimization to de-risk the loan and to make it truly a really responsible and affordable loan for that borrower, we went one step further and we said, you know what? We can now bask in that confidence and extend insurance directly to that borrower and protect that borrower and give them that peace of mind that if you lose your job or if you lose if you're on medical disability, we will cover every month's payment for you for up to 12 months because our research showed that when folks incur hardship, loss of income or loss of health, they work through that hardship and they're back on their feet 90% of the time within 7 months. So we figured, a blanket 1 year insurance coverage. And what this really means is the moment they incur that hardship, we begin right away making payments for that loan directly to the credit union who fulfilled the loan. So what we're going to show you here is two sides of the technology that makes this all possible. One is technology that is meant for you all. It's technology that we refer to as the business-to-business portal. It's the loan officer, it's the credit union, it's the lender's portal. And on that portal, you get to define where you'd like to uplift certain communities. Where would you like to actually expand and penetrate your reach and expand your balance sheet? And then the second part to that is, um, well, staying with that, we'll demonstrate to you how that portal allows you to really achieve something that we call precision marketing, to really get the loan officers, those loan offers out to those communities. And then the complement to that is as consumers and homeowners receive their offers, they land on a portal that takes really all the cost, time, labor, effort out of the journey. They come in, they type in their phone number, and we have achieved so many data integrations that we are able to automatically pull in. We're able to automatically pull in all the documents and verification information that's needed to underwrite that loan. And then we pass that directly off into your loan origination system, whether it's Meridian Link or any one of the others. So Abik, if you don't mind, let's pull up that first piece of technology that I alluded to, which is the B2B platform. And go ahead and log in. This is the first window that you would see as someone from the credit union that is interested in using the tool directly to define which markets you'd like to grow your home equity loan volume, home HELOC volume, piggyback second volume within. And uh, and I should also say that some of the partners, some of the credit union partners and bank partners that we work with, they actually just tell us to use the tool ourselves. And they'll just say that, look, our goal is to really serve Northern Florida. Our goal is to really serve maybe the Sacramento region or Chicago. So as the institution tells us which areas they'd like to serve, we essentially use this tool on their behalf to do the precision marketing. Before I dive in now into like a more detailed review of the tool, are there any questions, any thoughts from the group here so far? Okay.
Yeah, I'm not seeing
All right.
any questions or comments come through here. So
Okay.
yeah,
All right. So I'll just keep going then. Ben, please, if you see something come through, don't hesitate to just, interject midstream. So the main seat of the action is a map interface, because we know that it's really about places and communities that we want to serve and that we want to impact and we want to uplift. So when we're talking about communities, we're talking about places. And so what better way to engage with a place than a map? And so we zoom in on this map. What we're going to do is we're going to zoom into a part of the country that we're familiar with. We're headquartered here in DC. So I'm really familiar with the DC communities and areas. So we'll zoom in. And as we zoom in, what you're going to notice is there are red dots, yellow dots, blue dots, green dots coming up on the screen. What these dots represent are official government designated areas that are qualified as CDFI zones, LMI zones. If you're a bank, LMI zones matter because you get something called CRA credit, et cetera, et cetera, et cetera. So these dots are very precisely geolocated to represent all of the government designated areas in which loans can qualify for ESIP, for CDFI, for LMI credit. And this is where our partnership with CUCollaborate is so paramount, because a lot of that government data is not easy to access. It is noisy, it is scattered, and they've done a phenomenal job at pulling and culling and cleansing that data so that we can consume it. Now, as we continue to zoom in, the dots turn into very precise shapes. These are the very precise shapes that govern what are the boundaries within which loans must be originated to receive CDFI credit, CRA credit, ESIP credit for deep impact lending, et cetera, et cetera. One of those areas is right here. It's in a suburb that's nearby to us here in DC, Gainesville, Virginia. And so let's say that this is where a credit union might have a branch, or you might have, even if you don't have a branch, it's an area where you'd like to penetrate the market. So what you'll do is start drawing any random shape you'd like to signify the territories that you'd like to serve and market home equity loan products to in a precise way. So as Abik drew that triangle, that purple triangle, what is happening behind the scenes is the system is pulling back um, uh, thousands and thousands of records of every homeowner that might occupy a property underneath that purple triangle area. What we've done is we have not only integrated with the data that CUCollaborate has, which is in turn integrating with a lot of government data sets, we have also integrated through numerous other partners into thousands and thousands of county deed records. And by integrating into thousands of county deed records, what that does is it allows us to know who is every single homeowner, single family homeowner in this country. And so when that purple triangle was drawn, what we were doing is we were reading all of that data to understand who are all of those homeowners. Then what we also did is we looked at who are all the homeowners that are underneath all of the red boxes, all the red shapes that purple shape may have intersected. So if the purple shape pulls back, let's say 10,000 homeowners, and it intersects red shapes where the red shapes underneath them might be 5,000 homeowners, the overlap of the two is, let's say, 1,500 homeowners. Those are the 1,500 homeowners that, by virtue of what you have outlined when you defined the shape, are the ones that we'd like to now, in a very hyper-personalized, hyper-targeted way, hyper-tailored way, market personalized HELOC offers directly to them. And along the left-hand side, what you'll notice are some additional filters. What is the minimum home equity that you'd like for your market to have? Consumers, borrowers that you loan to, what is the minimum home equity that you'd like to start at? What's the maximum home equity? How many months of home ownership do you prefer? What's the credit score? What's the minimum credit score that you prefer? And what's the min and max CLTV? So we'll just leave these filters alone for now, but they're adjustable. And as soon as these filters are adjusted, what we'll do is, out of the homeowners that are brought back, that 1,500 that I mentioned, we'll subject each one to these filters. And then what's left is the number that you see on the right-hand side, which is 460. And this is real live data. This is not artificial data for demonstration purposes. We, in real live stream, queried the data set. This is all fresh data. It is continuously updated. And so there are 460 homeowners that are underneath both that purple box and that red shape, the purple triangle and the red shape, that also satisfy the criteria on the left. The median home value is 546,000. The median home equity that has not yet been tapped is roughly 281,000, and the median CLTV is 50%. And this is and these are all 460 homes that are LMI, CDFI designated. And then underneath, what you see is each individual homeowner and their particulars, because we are also pulling back not just our data integrations with AVM, with county deed records, not only with CUCollaborate, but we are also integrated with a number of AVM, automated valuation home appraisal providers, that are also sanctioned by Fannie Mae and Freddie Mac. And so we pull back all of that home value data and take the average of the multiple home value data fields that we just retrieved from the AVMs, put that on the screen for you, also put the home equity that's untapped on the screen, et cetera, et cetera, et cetera. So at this point, if everything that you have filtered and all the geospatial areas that you have earmarked all seem appealing to you at first blush, then what you could do is you could say, you know what, I'm happy with everything that I've done so far. You could save this off as a campaign that gets stored as long as you'd like for it to be stored in the permanent record. You could delete it at any time you'd like. And you could come back and create new campaigns off of this campaign. At this moment, what we now want to do is we want to really home in on that level of affordability. What is the right loan amount to offer each one of these homeowners so that they are truly receiving a credit facility that is affordable, safe, and responsible for them. And so what Abik's going to do is he's going to hit predict and optimize. And what we're doing is we're coming close to what that ideal loan amount should be during this optimization step. We don't nail it down to the penny, but we are within plus or minus $1,000 or so, because what we're doing right here is we're now doing soft credit pulls, and we're pulling in income, DTI, FICO, Vantage. We're pulling in a whole raft of additional data to really pinpoint to plus or minus $1,000, plus or minus $1,500, what the right loan limit should be. I'm going to just foreshadow something that will demonstrate a little bit later, but the foreshadowing is that the way to get down to the penny what the right loan amount limit should be is cash flow underwriting, where we pull in their monthly bank statements for the last 3 months and or 4 months, and we look at those monthly bank statements to gauge what their residual income is after all of their obligations are paid for, minusing that from their income streams, looking at that residual and using that residual to really nail down what is a safe monthly loan payment that they'll be able to afford to make, and then calculating the loan amount from there. And usually when we do that, we have seen that the original calculation that you see here on the screen came in around plus or minus $1,500. But once we pull in that cash flow data, we are right at the bullseye. And we don't need bank statements in PDF format. We tell the borrower, and again, you'll see this in a few seconds, we tell the borrower that, look, if you want to speed up your origination and your closing, you can just connect your bank accounts directly digitally through Plaid or through open banking. You could just make that connection here, and it'll retrieve all the documents that we need and do the processing behind the scenes near instantly. So anyway, at this point, you can take a look at what we'll do is, Abhi, can you launch one of those PDFs? This is just for demonstration purposes. It's a very personalized offer that now goes out to that homeowner. You see the specific loan amount, the APR, the monthly payments, all of that is customized for that homeowner, and it's shipped out to them. This, and you could take this off the screen now, Abhi. While this is going out through snail mail, at the same time, what we're doing is we are dispatching advertising on social media and digital media channels, Facebook, Meta, Instagram, and soon to be LinkedIn and Twitter and Google. All of that digital advertising is launched simultaneously with the snail mail advertising, so that psychologically we are ensuring that this audience within this hyper local area is made, really the odds are very high that we have indeed made them aware of these customized, personalized offers that these homeowners are now being extended by your institution. So at this point, what we're going to do is we're going to switch gears. The campaigns have been designed and launched, and as I'm talking through it, it certainly might seem like a lot, but it happens very, very, very quickly. You could draw those purple areas to be as large as you'd like or as small as you'd like. It doesn't matter. We're still going to really converge down to a very precise level of detail that encompasses individual homeowners within whatever area you draw. Now we're going to switch gears, and instead of demonstrating everything from the perspective of we're a credit union and this is how we engage in a precise marketing way and tailored loan optimization way with the market that's out there, we're now going to switch over to us being the consumer that is out there. And I've received this offer either through digital media, or I've received the offer through snail mail. And as I receive this offer, I now want to click through. And most of the time, what we are finding more than 99.1% of the time, what we have found is folks try to do everything that they can when they receive these offers right on their mobile phone. And so to show you the mobile experience, what Abik has done is he's taken the browser and changed it into a narrow aspect ratio to mimic what this would look like on a mobile phone. So on the mobile phone, they receive the offer, and all they need to do to now really kind of unlock that offer is put in their offer code, which AKA is their phone number. Even if they did not receive an offer from us in the mail, they can still, let's say that they randomly picked up on the fact that there are opportunities to get home equity loans in the Gainesville area from your credit union. This portal, by the way, is co-branded. It's right now you see branding that says GreenLyne, but it would be co-branded, and it would really also have your brand and your persona on the top left or on the top right. So you put in your phone number, and all the information that we already have is now retrieved. And this is all that's really needed. We wanted to make this a 5-second loan application process for the consumer. And that's it. Because with that phone number, we're able to pull back everything that we need in seconds to really show you what is your optimum loan limit. And again, this is within plus or minus $1,500, but we feel safe putting a single number out there. So in this case, it's $88,800. And that borrower can now simulate what is the monthly payment going to be for them on a 20-year HELOC, 10-year draw, 10-year payback, by going back and forth on the slider to simulate different loan values, and they see what their monthly payment would be. If they're happy with a certain loan amount and monthly payment, they hit continue or let's go. And we re-verify all the information that we have on them. If they'd like to make any corrections, they can. We show them some additional information that we've, go ahead, please head next. And as they continue to go through here, again, we're not asking them to provide us with any information. We are basically telling them, what have we automatically already integrated for you? And then this is where we say to them that, look, if you'd like to save, this is actually left over from one of the other credit unions or banks that we're working with, where what they're offering is some savings on the closing costs on the origination fee, which is if you'd like to provide PDF documents of your bank statements, income verification, et cetera, then you can certainly do that. But if you'd like to do this digitally and close much more quickly, then we'll save you $200. We being this credit union where this is a leftover from. They'll knock off $200 from the closing costs, and we give the borrower the option to go down the digital route. And so if they make that choice, they could hit yes and continue. And this is where they just link their bank accounts. Behind the scenes, this is something that you all might be already familiar with. It's Plaid. What we're actually using is a bank integration partner called Conductive, and so the borrower hooks up their bank account, and at this point, what we're doing is we're retrieving all the live bank account data, possibly 4 months, even up to 6 months of bank statements. And all of that information is being fed in to our back-end engine. And this is where we re-optimize that loan and adjust the maximum value of the loan if necessary. And that right there results in us taking all the credit pull data, the AVM data, the bank statement income verification data, all of that at this point is fully packaged, and we push it directly into your loan origination system so that the loan officer sees exactly everything that's needed for underwriting. And the final decision is in your hands. As the credit union, you're making that final decision of, do we extend this loan or not? Do we have everything that we need to extend this loan? Do we feel comfortable with everything that we have? Now, obviously, 100% of the time, you should, because we've taken all of your underwriting guidelines, we've taken your rate sheet, we've taken everything that matters to you already into consideration. Um, but again, we want that final approval to come from you and for your loan officer to have that final relationship with this consumer, with this homeowner. So it's pushed into the loan origination system. It's also pushed into some credit unions have CRM systems. They want it pushed into their CRM system, and we push it in there as well. And that completes the entire journey from our side. Everything that happens beyond that is now between your credit union and that borrower. Should that loan be originated and should it close, it automatically will come with, as long as this is something that you opt for and the borrower opts for, the insurance. If we stay within the loan limits that we optimized, as long as the borrower stays within that loan limit and that is the loan that gets originated, anything up to that size, anything below that size, we feel very comfortable insuring, and will extend that insurance coverage back to you as the credit union, so that if this person, again, just to repeat myself here, because it is so important, if they are unable to make a payment and they think that next month's payment is going to be hard for them to make, they've lost their job or they're on medical disability, they let us know, and then we take over the payments for them and start paying the institution, the credit union, directly. So you all have been very, very patient. I am going to pause there and really open the floor to questions, ideas, thoughts, any feedback. Real open floor here.
Awesome. Well, thank you for the presentation, Sid. As mentioned, yeah, please do drop in comments, questions via the chat function and/or the Q&A section of the webinar. I'm really curious, as we're kind of waiting on folks to digest the wonderful information that you've shared with us today. A little bit about how credit unions and/or community financial institutions that you're working with are approaching this from a like CFI or ESIP perspective. Can you talk a little bit about what you've been doing with the folks in that space? How are they approaching this work?
Yeah, it's very, very, very localized. But what's really interesting is, so there's a credit union up in Seattle, and they want to serve they want to serve that real local market. And uh, and what's really interesting is that even in this really localized market, the challenge that I think, and we didn't talk about this yet, but the challenge that we really solved for them is that um, their biggest concern and their biggest, I guess, uh, speed bump in the loan origination process was that the diversity of LMI borrowers has become really, really, really large, really wide. Um, 20 years ago, the spread of income, the spread of sources of income, all of those characteristics that loan officers may have looked at was more manageable because there is so much similarity across borrowers, even within the LMI cohort. But now what we're seeing and what they're seeing that presented a challenge is there was a massive amount of diversity. And folks really have become much, much, much more unique, especially with the gig economy, understanding sources of income, understanding sources of assets, explaining certain cash deposits. It really was a challenge for them that prolonged the loan origination process. And then so what happened is for them, a lot of the borrowers were just simply saying that, look, um, waiting around 25 days to get a loan, and then me just going on an endless chase of producing this piece of paper, that piece of paper, it's just not worth it. And then at the end of all of that, my house is put up in risk. It really, three times over, is not worth it for just a $20,000, $25,000 loan. I'd rather just spread it out across my three credit cards. So that's what we're seeing. You mentioned that what are we seeing from CDFIs? That's one CDFI whose story I think was one of the more compelling stories, is that they were just saying that we're suffocating underneath the weight of all of this diversification that we're seeing, and work that we need to do to really kind of explain the various assets and income streams that we see amongst folks.
Yeah, I'm actually seeing, so, obviously we work with a lot of credit unions that are exploring CFI certification or currently certified, and now navigating kind of a new regulatory environment since this CFI fund came back online last year. And so what we're seeing right now are credit unions who are really trying to build intention around who are
Mm,
they reaching, where are they reaching into, how can we, what I really love about this platform is, like, not only is it area based, place based, which is what you mentioned, but it's also individual. And so you can hyper localize in a way that is meaningful and pertinent to the strategies that credit unions are trying to work on. A lot of these credit unions, probably on this call here too, and actually I see some names that I recognize out there, and I know some of the strategies that they're working on is very intentional, right? They're saying, hey, we want to obtain or retain our low income designation, and we want to build in practices that allow us to reach those consumers and memorize them, have them join our credit union, leverage the products and services that we have, and it's mission based, right? And so we're seeing that credit unions really want to adhere to and exemplify their mission. And to me, this is another great example of a way in which you can take all the things that you talk about as a credit union and actually do them. And that was what one of the things that really kind of like made this very compelling argument to partner with you guys at GreenLyne. Yeah, when we're talking about how do we do the thing that we really want to do. I haven't seen any
I
questions
love
come through
hearing
the
that.
chat.
Absolutely love that, Ben, and I'm glad you brought that up because from our side, um, a lot of the innovations and this ability to do this precision marketing and the ability to do this precision loan optimization that gets us so comfortable on the responsibility, on the responsibleness and the safety of that loan, that we feel comfortable even offering insurance around it. These innovations happened while we were serving the mega banks, right? Like the JP Morgans of the world. But as soon as we were able to really kind of consecrate these and integrate and pull together these innovations, it became really, really, really clear to us that we knew what our mission was, which was to uplift the what we see is 20 million LMI homeowners that need perhaps less than $60,000 in terms of home equity loans. And we saw that that had really that mission to serve that cohort had really no appeal for mega banks. It matters for those that are really immersed within the very communities in which they live, right? And so CDFIs, credit unions, and I will say small local community banks, um, that's where we saw a lot of kinship. What was a mission for us wound up also being a deep mission for them, frankly, for all of you. And so that was really refreshing, and it made our path very clear that it wasn't the big Wall Street banks, but it was in fact the CDFIs where we're going to find common mind, common heart.
Right. So we do actually have a question coming through the chat. We have a couple. First one being, you mentioned this very early on, but if you could just spend a little bit more time on this. Question coming through, which is, are we only able to kind of source or identify home equity lines of credit, or are we able to tailor this to home equity installment loans or full conventional cash out refis? Can you just cover the various asset classes that you're able to kind of market to here?
Yes, it's all of those asset classes. And in fact, what's interesting is our beginnings were in first liens and was in mortgages, because it was really being able to close home ownership gaps that exist in this country. But we moved over into second liens because we just saw there was just a dearth of inventory. So whether it's cash out refis, piggyback seconds, HELOCs, HELoans, uh, home improvement loans, any those credit facilities where we feel that these are the credit facilities that have lower interest rates compared to other forms of credit, particularly non-secured forms of credit. Those are the ones that will pull in to our platform and optimize.
I have another question coming through here. You mentioned this, I think, in your introduction, which was how you're serving consumers on the insurance side of your business. Um, can can you expand more on, is there an additional cost to the credit union that you're working with for the insurance option that you had mentioned earlier?
There's no cost to the credit union. So there are two questions there. How are we surveying the consumers? We are not actively surveying the consumers anymore. This is over the years what we and some of our partners that we work with within the insurance industry itself. Um, this is through ongoing, rather deep dialogue with ordinary homeowners in the community, where we really started to learn that there's this big emotional hurdle of, hey, if I lose my job, I don't want to lose my home, and yet um, they uh, they could really benefit from a $25,000, $35,000 loan that they were, because of the psychological burden of putting their home up as collateral, opted to go with something that was 10 times worse. The interest rates were 3 times higher, and the loan repayment terms were 4 times shorter. So it creates a loan product that may have been, on credit cards, on personal loans, which the fintechs are gobbling up now, are was what we learned, and that's when we said that, okay, we need to figure out a way to provide peace of mind, and without putting ourselves at big risk. And that's where this notion of, let's optimize the size of the loan so that we could, through that optimum loan size, de-risk it enough where we could now protect the borrower. Now, on the second question that I think was asked, which is, what is the cost of the credit union? There really isn't a cost to the credit union. The way that this insurance works is we're directly insuring the borrower, and um, and if the borrower wants it, um, then we'll provide this to the borrower, and it really winds up being somewhere to the tune of 15 cents for every $100 of payment that is being protected. So if it's, let's say, if we're looking at something that is, let's say, a $40,000 loan, the monthly payments might be $300, and we're providing up to 12 months of protection. So it's 300 multiplied by 12, that's $3,600 of protection that we're providing. And if it's 15 cents for every $100, you're looking at a few dollars, $3 or $4 per month. And what usually happens is one of two things. That's either baked into the APR, which would go up by just a few basis points. It doesn't materially affect the APR that much, but it gets baked into the APR, and it's part of the APR. It's a part of the monthly payments that borrower makes to the credit union, that gets used to offset the premium for the insurance. Or the other way that this happens is right up front, as we're optimizing the loan and we're doing the precision marketing and facilitating the origination of this loan, whatever fees we earn right up front from that optimization and that precision marketing and precision origination, from doing all of that, the fees that we earn up front, we might just bump up those fees a very nominal level to cover the insurance premium cost.
Thank you.
You're welcome.
I don't see any other questions coming through the chat or the Q&A section. Last call here, and then we can wrap up. But just like a reminder, because we've covered a lot here today, and the offering of GreenLyne is so well-rounded that we will provide you with the materials from the presentation, a recording of today's webinar, and then Sid, actually, if you could, would you mind dropping your contact information in the chat for the folks who want to follow up with you? We will also provide a link to book a meeting if you'd like to schedule a follow-up with us in that email that will be sent out after today. We do have another question that's coming through the chat here. Someone's wondering, how long has this service product been offered? How long have you been on the market?
So before, it was something that was being done under a previous banner when we were engaged with fintechs and larger banks. So if we go back to those days, then it's 2014. But the decision to really consolidate and focus on the credit union space, community banks, CDFIs, is what resulted in the creation of GreenLyne, and it resulted in us really departing from working with the mega banks and with the fintechs. That decision was made about a year and a half ago. And so I would say that the most forthright answer to the question would be somewhere to the tune of 18 months.
And it looks like, okay, thank you so much for putting the email in the chat there. Don't hesitate to reach out to Sid and their team. Like I said, we'll have contact information in the follow-ups as well, and a meeting link to book directly so that we can connect and help your credit union explore how to work with GreenLyne around helping you achieve the strategic initiatives and adhere to the mission, do all the great things that you do as a credit union. So with that, Sid, any last wrap-up words here?
Other than just an immense thank you. An hour of everyone's time is a lot to ask for, and everyone's patience on the call. I noticed that there weren't a lot of drop-offs. So grateful. This is, I think, important. It's a really important mission for us, and having an audience like this is truly a privilege, though. So a big thank you to all of you.
Thank you, and appreciate your time today, everyone who made it out there. Big thanks to GreenLyne, and you'll hear more from us on this partnership soon. So thanks, everyone. Have a wonderful rest of your day.
All right. Thank you. Bye-bye.